distinguished participants, dear guests, ladies and gentlemen, it's a great pleasure for me to address you in the IIF G20 joint session. In fact, I remember the year when I joined the central bank as deputy governor. My dear friend Daniel is here. We also worked together with him from South African Reserve Bank. That was year 2003. And that was a year where Turkey had very significant problems to attain macroeconomic balance and then to achieve a higher platform for growth. So I'm very happy with the point that we came through the last decade. If someone were to tell me when I was teaching at Bilkent University in Ankara that you yourself are going to sign a bilateral loan agreement with the IMF and you are going to be ready to lend the IMF $5 billion when I was a professor at Bilkent University, I would not believe him. I would ask, in what capacity? They would say, you are going to become the central bank governor. And as a central bank governor of Turkey, you are going to sign this bilateral loan agreement. I would say, okay, I mean, you are stretching the limits of your imagination. So why don't I offer you coffee so that we can start fortune telling in a more systematic way? But it happened. So Turkey not only paid down more than $22 billion of debt to the IMF, all the way down to zero, successfully completed standby agreements, and then later on, in fact, became a potential contributor to the global safety net, financial safety net of the IMF. So it's very important to have a vision, to have a dream for any country. So there may be difficulties in any given country at the time, but if you really have a good vision and a determined plan implementation, which has elements of clarity, consistency, and commitment, you can always achieve success in your dreams. So Turkey did it. And now we are in a very different global environment. After the global financial crisis, Turkish story is again a success story. So I'm going to talk today a little bit about price stability and growth in Turkey. So the main messages, if this thing works. Okay. So the main messages in the presentation are summarized by these 3 sentences. In order to avoid the message to be lost in translation to Turkish, I am going to read the Turkish version of these messages while you are able to read the English sentences. The first message, birinci cümle, yüksek enflasyon ve deflasyon. Büyümeyi zayıflatabilen unsurlardır. İkinci mesajımız, merkez bankaları açısından büyümeyi desteklemenin en iyi yolu fiyat istikrarını sağlamaktır. Üçüncü tespitimiz, beşeri sermaye, istihdam piyasası, teknoloji, yenilikçilik ve fiziki altyapı alanlarında yapılacak reformlar Türkiye'nin büyüme potansiyelini daha da arttıracaktır. Now back to English. So the history tells us that there is always a feasible solution to the inflation problem. Many people forget, but inflation in the United States reached 12%, double-digit levels, towards the end of 1970s, after oil price shocks. And there was a solution. The solution was immediate, rapid monetary tightening, strong enough to make sure that inflation and inflation expectations fall at some short-term cost to the economy. This required some determination. And Paul Volcker had that determination, and he did it. He succeeded. By tightening money supply, he let the interbank overnight market interest rates all the way up to sufficiently high levels so that the inflation expectations and inflation itself came down very rapidly within the course of 1 year only, and very significantly. And that had huge long-term benefits for the United States economy. And the same for the globe, because this was a very successful disinflation example that other countries could follow. When that happens, you take away the so-called inflation risk premium from the real interest rates, so that real interest rates actually fall when you take inflation down. And that's exactly what happened during the so-called Great Moderation period after this successful disinflation. Let's look at Japan. Again, Japanese inflation was in extremely high double-digit levels in 1972, 1973, and then after a very similar 1974 tightening of monetary policy, there was the successful disinflation episode. But now, in both of these countries, the situation is such that inflation is below the desired levels of 2%, which is seen as consistent with price stability. Both of these countries, United States and Japan, are trying to, in fact, keep inflation and inflation expectations around 2% levels in the coming future. So how is the situation in Turkey? After the oil price shocks in the 1970s, Turkish inflation remained in double-digit territory for many years. For more than 3 decades, Turkish inflation hovered between 10% and 100%. Never went to hyperinflation territory, but was a high inflation country. So there are a few countries like this. In world history, you don't see many examples of this type of endured high inflation that never goes to hyperinflation. So this episode is very important because how did we go there? After the oil price shock went away, faded away, it was a monetary fiscal policy mix which was basically leading to this high inflation. Basically, monetary financing of budget deficits was the main reason. And therefore, after a very important structural change in year 2001, the solution to inflation problem was mainly found. That was a combination of fiscal and monetary prudence via a change in the central bank law, which ensured that there is no direct lending from the central bank to the Treasury for budgetary finance purposes. And the central bank is given an inflation target, which is determined jointly with the government, and then the central bank is supposed to reach that target with the instruments at its disposal. So this strategy worked to the extent that inflation came down to single-digit levels and stayed there since, as you see, 2004 and afterwards. We had mostly inflation hovering between 6%, 6.2%, and around 10% for the year end. So our target is 5%, and we are trying to bring inflation down further. And we have some success on that. I will show you how we are going to achieve that 5% inflation. So before that, let us think about the costs of inflation. So more than 35 years of high double-digit inflation did have some costs in terms of allocational efficiency. In what sense? Well, physical capital investments were extremely low during that period because equilibrium real interest rates were in the order of 15%, 20%, 25% real interest rates. With such real interest rates, nobody can invest in otherwise feasible projects. So because of that, the Turkish convergence process, the catching up process, which is normally expected from a low-income country, did not happen for many years. The per capita income as a fraction of United States GDP in Turkey remained mainly flat throughout the 3 decades period. After inflation started falling, we had the gains coming from mainly physical capital investments and mainly from the fall in the real interest rates, coming from successful disinflation and also fiscal prudence. So you see, the per capita GDP went up gradually, but we can also make a counterfactual experimentation. What if inflation were at 5% throughout the 30-year periods? Then per capita GDP of Turkey, rather than being hovering around 10,000 US dollars as of now, would be around 15,000 US dollars as of now, if you make this counterfactual calculation based on some growth regressions regarding the cost of inflation. So this is a big gain for Turkey. To bring inflation down is really a big gain, big success story for Turkey, which did help the growth to start, actually, to remove an obstacle from the private sector's road to success. So how about the other extreme? What if your inflation is too low, below your target, and if there is a risk of a negative inflation? What's wrong with it? What's the problem with it regarding growth? Well, the main problem is one of instruments. How are you going to stimulate aggregate demand by monetary policies if there is a zero lower bound on interest rates? So you cannot cut too much. You can always go to the negative territory, which is nowadays tried by some countries in Europe, especially. But you cannot really go too negative, because holding cash is always an alternative. So will it be enough to cut the rates to the negative territory to raise inflation expectations? We don't know the answer to that yet. What are the channels of transmission of negative nominal rates? It seems that exchange rate is one of the quite significant channels, but still we have very little experience with negative nominal rates. So therefore, many central banks also try some additional quantitative stimulus measures as well. It is more difficult to take inflation up when it is close to zero than to bring it down when it is above your target. This is a technical statement. Okay. So, oops. Okay. So if you just go back to your college years and remember this very simple equation, it tells you a lot, actually. Money, the stock of broad money, let's say M2, times the velocity of circulation of M2 is equal to the nominal expenditure, which is the product of the price level and the production, real output. So this M times V equals P times Y equation, in fact, tells you a lot about requirements for price stability. For prices to be stable, or for prices to grow in a stable fashion, you need stable money growth, you need a stable velocity change, and you need a stable output growth. If you have these three conditions, then obviously you have stable prices and stable inflation. Okay. The question is, how do you control money and credit growth? There are three potential instruments. The first one of these is the so-called nowadays fashionable macro-prudential measures, especially if you want to tighten money and credit. You can use these. And this is more for emerging market economies, but now talked more and more by institutions like Bank of England, like the ECB, European Central Bank, and the Federal Reserve. Why? Because they have extremely low interest rates, And therefore, there could be some pockets of asset price bubbles or other financial instability indicators. So for those, in a selective fashion, you can address these by the so-called macroprudential measures. So there is now some interest in this first item, not only in emerging market economies, but also in developed market economies. And that's why the Central Bank of Turkey, jointly with the BIS, Bank for International Settlements, have invited the central bank governors of G20 for an informal meeting today. We are going to start at 3 o'clock to discuss the experiences, compare notes with this macroprudential policy toolkit. This will be the first of its kind. It's not part of the official G20 program, but it is a side event which will be very useful. And I'm very happy that there is quite a significant attendance at the highest level to this meeting, which will really be quite useful in understanding what works and what doesn't, and to what extent. And what's the best combination of these measures to control money and credit growth. You could always also use these measures as a stimulus measure, but provided that you are tight. You are tighter than international minimum standards. If you are tight, then you can ease them. If not, obviously, you don't have any space to stimulate demand. Then the second option is quantitative easing. That is about the balance sheet measures, which we very well know, which has been used in Bank of England, in Federal Reserve, in Bank of Japan, and now in European Central Bank. So that is to stimulate, actually, demand because of the zero lower bound problems. And the final one is interest rates. Interest rates is a blunt instrument. It affects the price of every transaction over time, and it is obviously effective, but the negative territory is quite unknown, uncharted territory. So these 3 dimensions of policy can be used for the control of money and credit growth. Therefore, the change in money should always be monitored very closely for price stability. Let me go back to Turkey on a more positive note. Where are we in terms of achieving our 5% inflation target? The minimum over the last, as far as I know, 44 years has been 6.2% year-end inflation. So right now we are at 7.2. So we have some distance to travel to reach 5% by the end of the year. And if you'd like to talk about external exogenous factors, oil prices fall is helping us regarding this inflation quite significantly. But stronger dollar globally is not helping that much. So therefore, we are always monitoring day to day what is the net impact of these 2 variables on inflation outlook. And there are so much volatility in both the energy prices, oil prices, and the exchange rate, so that you better be patient and just monitor on a monthly frequency. So preferably once a month, it would be better to look at the inflation forecast. What's the net impact on inflation? Where am I regarding my 5% target? But that's about exogenous, external factors and shocks. If we go back to our equation, M times V equals P times Y, that is the main driver of the inflation, and therefore we should focus on that as the main reason for high inflation. So the statement that I put in this presentation is that a stable output growth, a stable velocity change, quite a predictable and stable velocity change, a stable money growth, which is now around 9%, 10% for M2, driven by a sustainable credit growth, which is slightly above our 15% reference rate, which favors production over consumption. Here you see the percentage change in business loans versus consumer loans. The red one is consumer, the line below is the consumer loans, and the blue line is the commercial credit growth rates, are the main drivers of disinflation in Turkey. So this is my long statement regarding the main drivers. Because the external shocks always have temporary effects. So these are one-time events. Oil prices may fall, may remain where they are. They will help this year's inflation, but not the next year's inflation. Currency could fluctuate, but that would have a temporary impact when it stabilizes. So therefore, the main driver, the main thing is money and credit developments in that sense, since velocity change is quite stable and predictable in Turkey. And growth is also quite predictable. So the main driver is money and credit change. And there we have hope, because the M2 growth mainly comes from private credit rather than government credit. The fiscal situation in Turkey is in pretty good shape. There is an ambitious balanced budget target for the end of the 3-year medium-term program of the government. So therefore, the main driver of money in Turkey is private credit. So there, the composition is improving, and the level is now closer to rates that are consistent with price stability and external balance. So therefore, if we can achieve a figure which is close to 5% by the end of this year, that will be a big contribution to Turkish growth, because equilibrium real interest rates will remain low and perhaps could even be lower after markets are convinced that this is going to happen. So that will be a real big contribution from the central bank to the potential growth in Turkey. How about the rest? How about the structural reforms? Now, I'm very happy again to see that the government has announced recently a structural transformation program to achieve a strong and balanced growth in Turkey by removing other obstacles from the private sector. So what are these? We can just summarize them in 3 headings. The first one is human capital and the labor market. The second area of reforms is technology and innovation. And the third one is physical infrastructure. There are some others, like boosting savings rate in Turkey and so on. But these are the main drivers of growth in Turkey. According to the Ministry of Development's calculations, a subset of these measures, if implemented, would add to at least 1 percentage point to the growth potential of Turkey. And this is very significant. So that's why Turkey, under the G20 presidency, puts a great emphasis on implementation of these structural reforms. Not only in Turkey, but also globally, because every country knows its own problems. Every country has the remedies, the recipes for structural reforms. So the key issue is to implement them. So there will be a monitoring mechanism among the G20 members. There will be some peer pressure on countries whether they do their own homework, which is assigned by themselves. So this is really a very nice mechanism for ensuring the implementation of these structural reforms. So therefore, we are all aware of the risks, and we are always talking about the risks, the tail risks, and so on, but we should always be aware that there are also positive tail events. So there could be solutions to the existing problems, and structural reforms is one of them. If these happen, if these are realized, then we can be more hopeful for the future of global growth, including Turkey. So let me just summarize what I read in Turkish at the very end. Both high inflation and deflation are detrimental to growth. The best contribution to growth from a central bank would be to maintain price stability. Reforms in human capital, labor market, technology, innovation, and physical infrastructure are going to boost the growth potential in Turkey. Thank you very much for your attention.